Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Did you know that the price of the next washing machine you buy might be quietly decided this week by a totally new financial deal happening, like over 7,000 miles away in Shanghai? Today, our mission in this deep dive is to look at a headline that, on the surface, it sounds incredibly niche.
Oh, very niche.
Right. It's about the London Metal Exchange.
Mm-hmm.
The LME teaming up with the Shanghai Futures Exchange.
Mm.
And we are going to decode exactly why this seemingly wonky financial arrangement is actually a massive shift for global manufacturing, for inflation, and, most importantly, for the everyday American economy.
Yeah, and what's fascinating here is that this isn't just about some new financial product being launched for Wall Street insiders. When you really dig into the mechanics of it, this is about China trying to pull global steel pricing into its own orbit.
Wow.
And in doing so, they're inadvertently creating this brand new, highly visible tool that everyday American investors can actually use to track the real-time health of the entire global economy.
Exactly. And for you listening right now, our goal is that by the end of this deep dive, you are going to understand how to read massive global trade signals just by looking at a simple roll of steel. But before we get into the actual financial deal itself, we really need to understand the physical stuff, right? We need to talk about HRC.
Right, the actual metal.
Yeah. So HRC stands for hot rolled coil.
Mm-hmm.
And to make this really simple, I like to think of HRC as like the all-purpose flour of the global economy.
The all-purpose flour. I really like that analogy. It captures the utility perfectly.
Right. Because think about it. If you walk into a bakery, flour is the foundational ingredient.
Mm-hmm.
You use it to make bread. You use it to make cakes, pastries, literally everything. In the industrial world, HRC is that foundational flat steel. It's the base ingredient used in almost everything around us. The frame of your car, your home appliances, like that new washing machine or refrigerator we just talked about, heavy machinery, energy equipment, and, well, even shipbuilding. It all starts with a massive rolled-up coil of this specific type of steel.
And if we connect this to the bigger picture, we have to make a really vital distinction here for our listeners between HRC and another type of steel you hear about constantly on the news, and that is rebar.
Oh, yeah, rebar.
Right. So rebar, or reinforcing bar, is the structural steel used in construction. It's the rigid skeleton of a skyscraper or like a massive apartment complex. Therefore, rebar is tied almost directly to real estate and domestic construction.
Okay, so rebar equals buildings.
Exactly. But HRC, on the other hand, is tied almost entirely to manufacturing and exports. That difference, the building versus manufacturing, is absolutely critical to understanding the global economy right now.
Okay, let's unpack that. Because when I review the economic data from the past few months, China's real estate market has been in, well, a severe crisis for about 5 years now.
It really has.
Yet the latest numbers show that new home prices in China dropped 0.2% in May of 2026. And that is actually worsening from a 0.1% drop they saw in April. And if you look year over year, those housing prices are down 3.5%. So the construction side of their economy, the rebar side, is struggling heavily. I have to imagine those factories are just hurting.
Oh, they absolutely are. But the manufacturing side, the HRC side, is telling a completely different story. Even with their domestic housing market slumping so dramatically, Chinese manufacturing exports are holding up incredibly well.
Wait, really? Even with the housing crisis?
Yeah, because we are talking about the production of electric vehicles, advanced batteries, heavy machinery, AI infrastructure components, and everyday household appliances. All of those booming sectors require massive amounts of HRC.
So if HRC is essentially the ultimate barometer for global manufacturing, and since China is like the biggest producer of it by a mile, how exactly does the rest of the world track its price? Especially when the center of gravity for all that production is sitting over in Shanghai.
Well, historically, it's been quite difficult for global investors or everyday businesses to directly access or, hedge against Chinese internal prices. The markets were somewhat isolated.
Okay.
And that is exactly what makes this new financial bridge so important. Because in October 2026, the London Metal Exchange is launching a new futures contract called LME Steel HRC Shanghai.
Now, wait a minute. I need to pause you there because I am trying to visualize this. When you say futures contract, are Wall Street traders in New York suddenly going to be physically shipping millions of tons of steel out of Shanghai on massive cargo ships?
No, definitely not.
Because that sounds like a logistical nightmare that a financial firm wouldn't want to touch with a 10-foot pole.
You're completely right. Not at all. Nobody on Wall Street or in London is taking physical delivery of a single roll of steel with this contract.
Okay, I'm confused then. If this is just a paper bet and no actual steel changes hands, why does the physical real-world market even care what this LME ticker says? Like, how does paper trading actually set the price of real steel?
That is the core of how commodities work. It's what we call price discovery. Think of the futures market as a massive global poll where investors, buyers, and sellers basically vote with their dollars on what they think a commodity will be worth in 3 months, 6 months, or a year.
Oh, I see.
Yeah. So even though no physical steel is moved by the traders themselves, the aggregate of all those financial bets creates a really highly accurate, transparent price benchmark. Real-world buyers and sellers then use that benchmark to negotiate their physical real-world contracts.
This is more like buying a proxy or a tracker. It sounds a bit like placing a bet on a sports game through an app on your phone rather than going out and buying the actual sports franchise yourself.
That's a great way to put it.
You have financial exposure to the outcome without having to manage the players or, like, clean the stadium.
That is a perfect way to look at it. It is what the financial world calls an offshore cash-settled contract. It is priced and settled entirely in US dollars. You don't have to worry about the logistics of moving metal on ships or checking the metallurgical quality of the steel or dealing with physical export tariffs at a port.
Okay, but what about the currency difference? China uses the yuan.
Right. So the LME has a sister company called CPL Commodity Pricing and Analysis Limited, and their entire job is to handle all the complex daily currency conversions from the Chinese yuan to the US dollar and then calculate the final unified price.
That makes the mechanics clear, but reading the reports, I have to ask, why does the LME, which is literally the world's oldest and most prestigious industrial metals exchange, why do they need Shanghai?
It comes down to a concept called liquidity, which essentially means having a market so full of active buyers and sellers that you can easily make a trade at any second without drastically shifting the price. And to get liquidity, you just need sheer volume.
And the numbers in the latest research are staggering. I mean, in 2025, the Shanghai Futures Exchange traded 169 million lots of HRC.
Wait, actually, for those of us not trading commodities full time, what exactly is a lot? Are we talking about a single roll, a whole shipping container?
Good question. A lot is just a standardized unit of trade. So in the case of this specific Shanghai HRC contract, one lot equals exactly 10 tons of steel.
10 tons. Wow. Okay, so doing the math, 169 million lots means they traded 1.69 billion tons of steel on paper.
Exactly.
Meanwhile, the LME's existing Chinese HRC contract traded a measly 139,109 lots. So Shanghai is trading an absolute ocean of steel, and London was trading a puddle.
That's exactly right. An ocean versus a puddle. And there is much deeper historical context here for why the LME is so willing to partner up right now. They desperately need Shanghai's volume and liquidity to repair their own reputation, because in 2022, the LME suffered a massive historic crisis in their nickel market.
I remember reading headlines about that, but what actually happened behind the scenes? Essentially, the price of nickel skyrocketed so fast due to a short squeeze that the exchange's systems and members couldn't handle the massive financial demands or margin calls required to back up the trades. It became a huge systemic risk.
Oh, wow.
Yeah. So the LME did something pretty unprecedented. They panicked, suspended all trading, and actually canceled billions of dollars worth of completed trades.
Wait. So if you were a trader who made a brilliant, highly profitable bet on nickel, the exchange just hit the undo button and wiped out your profits to save the system.
Yes, they literally hit undo. And as you can imagine, it severely damaged the fundamental trust that global investors had in the exchange. So since that 2022 crisis, the LME has been on a desperate mission to rebuild that trust and expand their product offerings to prove they are still the center of global metals trading.
And they know that deep liquidity breeds trust.
Exactly. Because they couldn't build that liquidity organically on their own with HRC, they are tapping directly into Shanghai's massive pre-existing pool.
Okay, here's where it gets really interesting, though. I understand why London needs Shanghai. But if China is trying to hit the brakes on production down the line, why are they agreeing to export all this financial influence right now? Especially when their domestic steel industry is actually going through a really rough patch.
It's a great question.
Because according to recent data, Chinese physical steel production actually hit a 7-year low in 2025. Wait, if production is at a 7-year low, Why are all the reports talking about a global flood of Chinese steel?
It is a fascinating paradox, really, and it gets to the heart of global economics. You would think a country would want to internationalize its commodities when its domestic economy is booming, not when it's slowing down. But the reality is that China's internal demand has just collapsed.
Right, because of the housing slump.
Exactly. Because of that severe housing slump we talked about, their massive factories can produce far more steel than their own citizens and builders can currently consume.
So they have to keep the factory lights on somehow.
Precisely. They have this massive oversupply, and shutting down factories would mean massive domestic unemployment, which the government wants to avoid at all costs. So they are trying to keep their factories running by exporting the surplus. They are literally flooding the globe with incredibly cheap steel.
Flooding is definitely the right word. One of the research papers we reviewed highlighted that Chinese HRC has been selling for anywhere from $11 to $37 cheaper per ton in places like India compared to the locally produced Indian steel.
Yeah, it's a huge margin.
In the commodities world, where profit margins are razor thin, undercutting the local market by up to $37 a ton is absolutely devastating to the local producers.
It is. And the Chinese government is very aware that this aggressive oversupply is becoming a major global political problem. They know they can't just, export their way out of a domestic slump forever without severe backlash. So they are starting to put some guardrails in place. They've actually announced a hard cap on crude steel production for the years 2026 through 2030.
And beyond just capping production, the data shows they're introducing a brand new export licensing system for about 300 different steel products starting in 2026. But how does an export license actually slow things down?
Well, it creates bureaucratic friction. Instead of a factory just loading cheap steel onto a ship whenever they want, they now have to apply for government permission for every single shipment of those 300 specific products.
Oh, so it's a bottleneck.
Exactly. It
Yeah.
gives the central government a throttle. They are trying to manage their domestic slowdown by pushing the excess steel outward to survive today, but they're installing these licenses and caps to slowly rein it in over the next 5 years.
Okay, so if China is hitting the brakes on production down the line, but furiously exporting right now, where's all that cheap metal actually going? Who is buying it? Which I guess brings us to the shifting centers of gravity in the global economy. Looking at the analysis, the global demand for steel isn't disappearing, it's just moving to new zip codes.
Exactly right. While China's massive multi-decade growth spurt is slowing, other regions are booming. India and the ASEAN region, which includes countries like Vietnam, Indonesia, and Thailand, they are going through massive phases of infrastructure building and rapid urbanization.
Like China did 20 years ago.
Yes,
Yeah.
exactly. We are talking about entire megacities being woven together with new highways, modernized power grids, and sprawling transit systems. They are building the infrastructure today that China built back then.
Just to give you a specific projection from our sources, India plans to more than double its domestic steel production. They want to go from 168 million tons currently
Yeah.
up to an astonishing 400 million tons by 2035 or 2036.
It's massive.
Yeah, just to put that in perspective for the listener, adding over 230 million tons of steel capacity is like building the entire U.S. steel industry multiple times over, from scratch, in a single decade.
That is explosive, historic growth. But here's the friction point. When you have a massive producer like China desperate to offload too much cheap steel, and a growing consumer like India trying to protect its own infant factories, or even established markets like Europe and the US trying to protect union jobs, those cheaper Chinese exports inevitably trigger global defenses. They hit a protectionist wall.
And looking at the current U.S. administration under President Trump, the sources highlight a strong focus on domestic protectionism. And just a reminder for our listeners, we aren't taking any political sides or endorsing these policies here. We are strictly reporting on the trade dynamics outlined in the research. But the reality is, when cheap Chinese steel floods into global markets, whether that's India, Europe, or North America, it instantly leads to tariffs, anti-dumping laws, and intense trade friction.
Exactly. It's a huge point of contention globally.
Actually, can we define anti-dumping laws quickly? Because that term gets thrown around a lot on the evening news, and I want to make sure we're clear on it.
Of course. So dumping is an economic term for when a country exports a product at a price that is lower than what it costs them to actually make it, or lower than their own domestic price.
So they're taking a loss on purpose.
Yes, they take a loss just to capture market share and drive foreign competitors out of business. Anti-dumping laws are special emergency tariffs that a country like the US or India will slap on those specific imports to force the price back up to a fair competitive level.
Got it.
And this raises a really important question. Why does the actual pricing mechanism matter in the middle of a sprawling trade war? China realizes that if they are going to inevitably face these protectionist walls and tariffs all over the globe, they absolutely need a seat at the global pricing table.
Right.
They don't want the baseline price of the world's most important manufacturing metal to be dictated solely by exchanges in London or New York without their input.
They didn't want to be the ones who set the baseline.
Precisely. And they have a history of doing this successfully. Look at how they used the China Mineral Resources Group, or CMRG, to negotiate iron ore prices with global mining giants in Australia and Brazil.
How does CMRG actually do that, though? How do they force the hands of these massive multinational mining companies?
Because they consolidate all of China's immense buying power into one single unified entity. Instead of 50 different Chinese steel mills bidding against each other and driving the price of Australian iron ore up, CMRG walks up to a massive miner in Australia and says, "We represent the entire country of China. Give us a massive discount or we buy zero."
Wow, that is incredible leverage.
It really is. They want to engineer that exact same monopoly power, but for selling HRC. They want their domestic HRC price, the one set in Shanghai, to become the undisputed global benchmark. They are essentially saying to the world, we are the biggest producer and the biggest exporter. Our price should be the world's price.
So what does this all mean? We've talked about billions of tons of physical steel, Shanghai futures, London exchanges trying to save their reputation, and massive global trade walls. How does an everyday American investor, someone just trying to understand the economy or manage their basic retirement account, actually use this new financial tool?
It's a great question because you absolutely do not need to be a Wall Street commodities trader in a fancy suit to find value here. Think of this new LME Shanghai HRC futures contract as a high-tech economic thermometer for your beginner investor toolkit.
Okay, thermometer.
Right. It gives you three incredibly clear readings on the direction of the economy. First, it is a brilliant early warning inflation gauge.
Ah, right. Going back to our flour analogy from the beginning of the deep dive, if the wholesale price of flour goes up, the local bakery ultimately has to charge you more for a loaf of bread.
Exactly. If you open your investing app and see this new China HRC price consistently trending upward, it means the raw foundational cost of global manufacturing is rising. Because steel isn't everything, that cost eventually gets passed down to you, the consumer.
That makes total sense.
It means that in 6 to 12 months, the price of cars sitting on a dealership lot in Ohio or the price of appliances at your local home improvement store is likely going to go up. It basically takes the guesswork out of consumer inflation.
Wow, so you can literally see inflation building in the pipeline before it hits the store shelves. That's huge. What's the second way to use it?
The second tool is looking at what financial analysts call relative value, or the spread. Now that we have a highly visible, globally traded price for Chinese HRC, everyday investors can compare it directly against the price of U.S. Midwest HRC.
The spread. Okay, so we are comparing the price of American-made steel right here at home versus the baseline price of Chinese steel.
Yes. And this is the ultimate mathematical test of whether global trade policies and tariffs are actually working.
Let me try to visualize this for a second. Think of the U.S. steel price and the China steel price like two boats floating on a river. Usually in a totally free market, they float together at the exact same level.
Right.
But if government tariffs are a giant dam blocking the river, the China boat sinks lower because of their massive oversupply, while the U.S. boat stays high and dry on the other side of the dam.
That is a brilliant way to picture it. If you see that widening gap, that spread where U.S. prices stay high and stable while China's prices crash, it is a clear signal that the tariffs, trade barriers, and regional supply chain blocks are actively working. It means the U.S. market is successfully insulated from the flood of cheap foreign steel.
But the moment you see that U.S. boat start sinking rapidly to meet the low China boat, you know the dam is broken.
Yes, exactly.
It means those defensive walls are leaking, and cheap foreign steel is somehow finding its way into the domestic market. That is a really powerful way to visualize complex geopolitics just by looking at two numbers on a screen.
It really simplifies it.
Okay, so what is the third tool?
The third is understanding direct stock impacts. You can use this HRC price to gauge the health of specific companies in your portfolio. For instance, if you own stock in a major American steel producer, you want to watch the relationship between HRC, which is the final product they sell, and iron ore, which is the raw dirt they have to buy to make the steel.
So it's all about their margins.
Exactly. If the global HRC price is strong and stable, but the price of iron ore is weak and dropping, that steel company is buying its raw ingredients on the cheap and selling its final product for a premium.
Which is the dream scenario.
Right. That spread means wider, healthier profit margins, which is almost always a fantastic signal for their quarterly earnings and ultimately their stock price.
That is such a practical, grounded breakdown. It really proves that you don't need to be actively trading highly leveraged metal futures in a brokerage account to care about this stuff.
Not at all.
You just need to keep an eye on this new LME Shanghai HRC price to know if the underlying cost of manufacturing in the U.S. and ultimately the price of the goods on your local store shelves is about to go up or down. It takes all the academic guesswork out of reading the global supply chain.
It really does. It simplifies the noise. But, if we pull back, it also leaves us with something much larger and frankly more concerning to consider as investors.
Oh,
Yeah. If China successfully financializes its steel price through this new LME deal, gaining absolute global pricing power without actually fully opening its own domestic financial markets to the rest of the world. What happens when they apply this exact same playbook to the critical, highly contested metals of the future? We are talking about copper, aluminum, or the electric vehicle battery metals that will define the next century of technology.
don't forget to subscribe and hit that like button.